from Frankfurt. Okay. Acha. Users of financial statements. So, madam, we learned yesterday that what these financial statements are. The question is that is it just a useless exercise or does it have some useful purpose? Meaning thereby that are there any groups of people who look forward to seeing the financial statements of a business? Who is that particular? What are the different groups of people who would be looking forward to that? And to what use would they put these financial statements? If you could please explain that. So, for example, who would be the users of the financial statements of a business? You have your business of boutique. Who would use the financial statements of your business? You would. So the first person would be the owner of the business themselves. And why would they like to look at the financial statements of a business? What's exactly that they would be looking at in those financial statements? Hmm. Hmm, hmm. So they'd be equally, I mean, since they own the business, they'd be interested in everything. They'd be seeing how much revenue they're making. They'd be interested in how much expenses they're incurring, thereby telling them how much profit they're making. And then they'd like to see that what's the total amount of assets that they have, what's their total investment in the business, how much of the assets that appear in the business, yes, they appear in the business, but against them there has some liability that has arisen in the past as well. So they have to settle those liabilities as well. So they would be looking at all of these things. Who else would be interested in the financial statements of a business? The managers. What would hmm. So managers, this is something that we'd learn. For small entities, yes, they start in a way that owner is the manager and he is taking care of all the stuff. But as the business grows, they need to employ first more employees, and eventually, as it grows, they'll have to introduce some hierarchies beneath them as well. And those hierarchies then involve some managers, whatever title they hold. So usually, and that's the case of small businesses. In big businesses such as public limited companies, what happens is that you have a group of people who are owners of the business, who are the shareholders, but shareholders are not necessarily involved in day-to-day management of the business. That is something that is handed off to management. It's part of management who are custodians on behalf of shareholders to run the affairs of the business. And then the financial statements, the managers, they'd be looking at first of all to make decisions, and secondly to know that how well are they using the financial resources, or how well are they generating revenues and profits out of the financial resources for which they were made responsible. Okay. Who else could use the financial statements of a business? The buyer. So for example, if ever there are a few ways to own a business, the first way or the simplest way is to start a business yourself. You have an idea, you want to start a venture, good, go ahead with that. Another way to do a business is that some people, they might think that it's too much of a hassle to start a new business. What they think they can do better is that I don't want to go through all the hassles of starting a business. What I'd rather do is I'd buy a business which has already been started up by someone else, and I'll just manage that business in a good way. Okay, so this person, whenever he wants to buy a business, he'd ask for the financial information of the business. Only then he'll be able to judge what money should he be ready to offer to buy this business. And to make that judgment, he'd need to look at the assets that he is buying. He's going to look, he'll need to look at the liabilities that he'll eventually be responsible for. He'll need to see that historically how much profit this business has been generating. So all this information again would be there in the financial statement. So prospective buyers of the business, prospective buyer is someone who is just looking at the for example, speculating at the opportunity of buying this business, that whether should he go ahead with this or not. He is just uh, uh, making estimates right now. He's not 100% sure that yes, he's going to go ahead with this thing. Acha. Then it says tax inspectors or the bank. So the bank in the case you ask for a loan, yesterday I told you the story of an auditor, that what would an auditor do? Usually they audit the financial statements, and I told you that somebody, if you present them your financial statements, they wouldn't right away place reliance on them, because when you are preparing your own financial statements, you could have a bias to present information better than it actually is. So there could be an inclination to overestimate your profits, or overcast your, I mean, as in uh, inflate your assets, right? So the person who's owner of the business himself, they might have that tendency. So in order to take away that bias, the financial statements, they are usually asked to be audited by a third person, an independent person. Where do these audited financial statements they come in handy? For listed or for public limited companies, it's a legal responsibility that you have to get this done. As all these structures, public limited, private limited companies, sole proprietor, this is something that you'd soon learn in your business classes. Acha. For other businesses as well, if you ever want to take a loan from the bank, so yesterday we discussed about the sources of finance for a business. One source was that you invest your own money in the business. The second source was that you take some liability. The liabilities, they can take different forms. So one of the liabilities is loans. If you want to take loan from a bank, what would they ask for? Your previous financial statements, which have been audited, and also your future projected financial information. Okay. One more thing to point out in this regard, all the accounting that we are going to do, it is going to be based on past information, that some event has happened in the past which has already given rise to a financial impact, or it will give rise to a financial impact. But all the information that, so for example, I cannot do accounting that in my current year's financial statements, I show that in the next year I'll earn this much profit. That I'll show in next year's financial statements. This year's financial statements, I cannot show that. Okay. So accounting, the financial accounting that we are doing, it's based on historic information. Acha ji. The same way the banks, they ask for financial statements, the tax authorities, they are required to calculate the tax that a business is liable to pay, and how would they make estimates of how much tax a business is liable to pay? Again, by looking at the financial statements of the business, because that is where the profits and the incomes of the business, they would be disclosed. Similarly, investor. What would be the difference between prospective buyer and an investor? Hmm. Excellent, excellent. That would be the difference. So he is going to buy the controlling share, or he wants to become the main player of the business, the one who perhaps owns the majority of the shares, and an investor is who just wants to own a part of the business. Excellent. Acha ji, the other thing that I wanted to discuss about, other than the uses of financial information, it is that where is all this financial? So, for example, we said that this is the definition of asset, this is the definition of equity. These are the financial statements. Where do I pull out these definitions from? Okay, another question, a different way to frame this question is that what are the rules of accounting, and is there a universal set of rules of accounting? First of all, is there a need to have a common set of rules for accounting? If no, then why? And if yes, then why? Excellent, excellent. So if there were no rules, no universal rules or no common rules, you'd do accounting your own way, I'd do accounting my own way. You'd say my profit is this much, I'd say my profit is this much, you'd say my assets are these much, I'd say mine assets are these much, yet the amounts wouldn't be comparable, because you would have your own standards and rules for measuring the profits and assets, and I'll have my own. So that way things wouldn't be. If things they are being drawn according to the same principles, only then it becomes meaningful to compare the information. Very good. The next question is then, what are the rules? Do you know of any rules that exist using which we prepare all this information, or anything about that? Okay, so we have a few things. So historically, previously we had this what we call these were IAS, International Accounting Standards. Okay, IAS, and there was IAS 1, IAS 2, IAS 3. Each standard it pertained to a different accounting issue. IAS 1 was sort of the introduction in which they gave a holistic framework of how all these accounting standards are, the basic definitions, what the financial statements are, that these are the financial statements. How do we know that there are five basic financial statements, or a complete set of financial statements would have five statements? Why not six? Why not three? Why not two? Because it's written in IAS 1. Secondly, how do I know what's an asset, what's a current asset, what's a liability, and all these things? Again, these definitions they have been described in IAS 1. Other, for example, conditions which have been mentioned or which were mentioned were, for example, whenever you present the financial information, you have to present at least 1 year's comparable. So if you are presenting the financial information for the year 2012, along with it, you'll have to present the financial information for year 2011 as well. If you remember the accounts that I showed you for everything, there was a corresponding last year's figure as well. Okay, so again, that is not by chance, that is a requirement of accounting standards or international accounting standard. Then the IAS 1, it also says that either you apply all the IASs and IFRS. So previously these were called IAS or international accounting standards. Now the new standards which are being issued, they're issued with the name IFRS, International Financial Reporting Standards. Okay, so previously we had IS1, IS2, IS3, and now we have got IFRS 1, 2, 3, 4, and so on. So, for example, one IFRS it would deal with how to account for leases. One IAS or IFRS it would deal with how to account for revenue. One would deal with how to do accounting of inventory and so on. Acha ji, acha ji. So this is where these are the sort of most commonly followed framework. Is this the only framework? No, there are others as well. For example, in UK and perhaps in USA as well, we have something called GAAP, Generally Accepted Accounting Principles. The UK ones, as far as I believe, they do not differ a lot from these financial reporting standards, IFRS or IAS, but the US ones, they are a bit different. But anyhow, these are a few frameworks which are used around the globe. We'll be using the IAS and IFRS. The accounting that you're taught in your syllabus, it mostly pertains to it's what's been told in these IAS and IFRSs. All right. Acha ji. Now coming back to what we were discussing yesterday. Acha ji, we wrote down five heads of accounting, and we mentioned that these are the five classes in which all the accounts that a business prepares. Acha, also to give you some terminology as well. Um, the financial statements or the accounting information that a business prepares, they are also called books of account. Sometimes they're simply called books as well, books of a business. That is why maintaining these accounts, this activity is also referred to sometimes as bookkeeping. Okay. Acha. So all the accounts that we'll have, they'll be classified into one out of these five classifications that we discussed the definitions of yesterday. Today we'll begin to see how to do accounting for each of these five classes of accounting heads that we have got. Acha, the only two things that can happen to any of these accounts is that either it's going to increase or it's going to decrease. So we should have a rule of how to do the recording for example, for increase of asset and for decrease of asset. Similarly, there should be a rule for an increase in equity or a decrease in equity, an increase in liability, a decrease in liability, the same for expense and the same way for revenues as well. So I'll write over here once again the five heads. Um, okay, so number one, assets. Number two, liabilities. Number three, equity. Number four, revenues. and number 5 expenses. All right, madam. And the two rules, they should be one for an how to account for increase, and there should be one rule as in how to account for decrease in that particular head. All right, Ji. What about assets? For asset, if an asset increases, we debit the account. What exactly debit means, we'll see in a bit. But right now we have to remember, if an asset increases, we debit the account. And if an asset decreases, we credit the account. For liabilities, equity, and revenue, when they increase, we credit the account for all three of them. I mean, for each of them. Credit, it's credit. Increase is recorded as a credit, and decrease is recorded as a debit. So it's opposite to that of an asset, the rule. Here it would be debit as well. And what do you think it would be for expenses? Excellent. Increase debit and decrease credit. So this is something that you should memorize. We aren't really allowed to get tattoos, but I mean, even if you're sleeping and somebody throws water on your face and you suddenly wake up and they ask how do you record increase in equity, for example, you should know we credit the account. So you should be that well versed in it. And the other question is, do I know the logic of it? So we had this one teacher back in the day who used to say कि बेटा रट के समझ लो या समझ के रट लो, लेकिन you should know this thing. I mean, it's verbalize and memorize this thing. The rule, if you want to remember, is that assets and expenses, they are both their sort of purpose is to benefit you. So expense, it has already benefited you. For example, the salaries that you have given to people, they've already given you the benefit, right? And the assets, for example, the cars and buildings and inventory that I have, they'll give me benefit for some time to come. So that's why their accounting is same, and for the other three items, the accounting is the same. Okay. Acha ji, have you noted this down? ठीक है जी. Moving ahead with the accounting, and let's the initial for the, let's say, a few classes, we'll be looking at the accounting of just first three items: assets, liabilities, and equity. In the book, the example that we are going to look for, that we are going to follow, instead of equity, the term capital would be used. But I think the equity is the better term to use, because of the reason that capital is one of the components of equity. So if we learn just about capital, so for example, we learned over here yesterday that for equity, what gets included in equity. So we said it includes share capital, retained profit share premium. So all these things that are included in equity, and all of them have the same accounting. To say capital, yes, it makes things easy in the start, but later on when we study about other items, then it becomes confusing that previously you told us it was capital, now you're saying it's equity. So right from the start, I'm telling you it's equity. In the book, they're just using the term capital, but we would know it's the same thing. Okay, Ji. Moving on, the accounting equation, coming back to it, let me write it over here. Assets are equal to equity plus liabilities. Knowing maths, since you got an A star already for your add maths, you would know that if something's increasing on the left hand side of the equation, it would involve either some increase of the same amount on the right hand side, or it would be counterbalanced by an decrease on the left hand side. So a few possibilities are that an asset increases and an equity also increases. The equity also increases. Another example could be that asset increases and a liability increases. Okay. Another example could be that one asset increases and another asset decreases. Okay. Let me give you example for all these three situations. So the first situation, the example could be owner invests money in business. So as owner invests money in business, the equity, the interest of the owner, that is increasing, as well as the asset in the business, which is money or bank account or cash, whichever form he is bringing it, that's also increasing. Okay. A common example of the second case is that you buy assets on credit. So it could be inventory, it could be any other asset. For example, fixtures, buy asset on credit. So when you buy an asset on credit, for example, you bought furniture on credit, the asset of furniture is going to increase, as well as a liability, a corresponding liability is going to increase, which would be that you have to pay to that person from whom you have bought the goods on credit, right? Similarly, if you're buying anything on cash, cash purchases, let's say you're buying inventory for cash. So your asset of inventory, in fact, let's not talk about purchases right now for some reason. Let's say you bought a car, you bought a vehicle on cash, paying by check. Bought vehicle, paying by check. Acha ji, we would know the difference between a person we doing our self accounting for our personal finances and the finances of a business. One of the many differences would be that for personal users, we mostly make payments through cash. For businesses, payments they usually get done by check. Acha ji, so this involves the asset of vehicle increasing and the asset of bank decreasing. Another thing, if you notice, this is there are a few underlying principles in the accounting that we'd keep on learning from time to time. This is called principle of duality. Every transaction, it would have two impacts. Every financial transaction that we have, it will have two impacts. That's the concept of duality. Another concept that we have started applying, that would be separate entity concept. Business is a separate entity from the people who own the business. So anything, any financial event that happens in my personal life does not get reflected in the financial statements of the business. All the personal expenses that I'm making, no matter what, they wouldn't get reflected in the financial statements of the business as long as they do not relate to business. Business is a separate entity. The person who owns the business is a separate entity. Okay. Acha ji. And since we are doing the accounting for the business, we will record only the amounts that pertain to the business itself in the books of the business. Acha ji. This now let's look at the few examples from this book that we have. Okay. 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 They start teaching the balance sheet right away as well. What do we do? What do we do? What do we do? Okay, we'll just focus on the financial, the accounting equation part as of now. Okay. What happens on the 1st May 2017, or let's just make the okay, the balance sheet, we know that it's the statement of financial position, right? Okay. For every transaction, we look at the accounting equation impact of it, and we'll also look at the statement of financial position impact of it. So on 1 May 2017, B. Blake, he starts business with 60,000 pounds and he deposits that in a bank account, and that's all he does. That's how the business starts. So if I look at the accounting equation, what's happening over here is that the person, he is starting business by investing some money in the business. So assets are equal to equity plus liabilities. So assets are increasing. He's investing money in business. Assets of business are increasing, and equity of the business is also increasing. Okay. As far as statement of financial position is concerned, we saw yesterday it's drawn that first we write all the assets. There's a list of assets on, and for each asset we write down the amount. So right now the only asset that he has is bank. How much? 60,000, and that's it. That's the total amount of assets. The same way, equity, how much money he has invested in business, that is also 60,000. So yes, accounting equation is also satisfied in statement of financial position. If you remember from yesterday, I told you that statement of financial position, it's drawn on the principle of accounting equation. Assets are equal to equity plus liabilities. So we show the sum of all the assets, and we show the sum of all the equity and liabilities, and the two should come equal. So here we can see the sum of assets is equal to sum of equity and liabilities. If you say where are the liabilities, as of now the liabilities are zero. So the zero amounts I usually do not write. So the sum of equity and liabilities, I can see, yes, it is 60,000. Okay. I just didn't want to get into the drawing the statement of financial position part. It might slow us down a bit, but anyhow, it would give us some practice, so no harm. Acha, another thing in accounting, presentation is also important. So, for example, whenever I put this double line beneath some figure, it means that the amount above it, they have all been added, and this amount now it does not relate to anything that's written over here beneath it. Okay. And if I put just a single line like this over here, so it would mean all the amounts above it, they get summed up until the previous line that was put. So between this line that I've put and the line before it, all the amounts they get added up. Okay. Okay, and again, since this is the final sum that we have got, we'll put the double line beneath this one as well. So this was the first transaction for the business. Let's look at the second one. What he does next is he purchases an asset, shop, paying 32,000 by check. So he's paying 32,000 by check. That would mean that if I redraw his statement of financial position now, statement of financial position, I show assets. There was this asset of bank. Previously it was 60,000, but now out of that 60,000, he has already paid 32,000. So how much is left? 28,000. And if one asset is reducing, either equity or liability must increase. No equity is increasing, no liability is increasing. So one asset is decreasing. Equity and liabilities, they should decrease. Okay. If an asset is decreasing, it should be corresponded by either a decrease in equity or a decrease in a liability. None of these two are decreasing. It means another asset is increasing to compensate for it. Acha ji. Which asset is increasing over here? Shop. By how much? 32,000. So that gives me the total sum of assets in the business. It stays at 60,000. Equity, it still stays at 60,000. And liabilities, they still stand at naught. ठीक है जी. Am I going too fast or are you following the pace at which I'm teaching? ठीक है जी. Let me know if I need to slow down. If you want me to slow down. अच्छा जी. This. अच्छा जी. The next transaction, what does he do? If you could please read out the transaction number 3. So what's happening over here if we redraw the accounting equation to highlight this event? Assets are equal to equity plus liabilities. An asset is increasing, and it's not an existing asset, it's a new asset. Okay. And this new asset which is appearing on the books, is it appearing because another asset is decreasing? No, rather it's appearing because the liabilities have also increased. So if I draw the statement of financial position, the previous assets, they haven't decreased, so they will stay as it is. Bank would stay at 28,000, no changes to that. Shop, it stays at 32,000, no changes in that. He has bought goods or inventory of worth 7,000, right? So his total assets have now become 67,000. And if I look at the equity and liabilities, looking at the equation, there hasn't been a change in equity. So equity stands where it stood before, 60,000. And liabilities, yes, they have increased now because he has incurred a liability for how much? For 7,000. Acha ji. So the sum of equity and liabilities, again, it comes out as 67,000, which is same as the sum of assets. ठीक है जी. Any confusion in this transaction? Any confusion in the way things are progressing this far? I mean, the accounting for or the treatment for anything or any explanation at all? ठीक है. If I asked you at the end of the lesson to give me a recap, would you be able to? All right. ठीक है जी. ठीक है. अच्छा जी. The next transaction, if you could please read and let me know what's happening. Number 4. Okay, we discussed yesterday that there are two types of transaction based on when the payment it gets settled. So if it gets settled immediately, these are called cash transactions, and if the payment is deferred, these are called credit transactions. So is this a cash transaction or a credit transaction? This is a credit transaction. Excellent. And for this credit transaction, it's worth how much? It's for 600. So again, the first thing that we'll do is we'll look back at the accounting equation. For accounting, if ever, okay, this is something that will right now there are few things and simple things, and it's quite easy to keep track of them. Later on, when you'll have a lot of financial information, and then there would be just this small adjustment to make. These are the sort of things that usually confuse students. So in order to always stay with a grip on things, the best idea is to always think of the double impact that any financial transaction creates. Every transaction, we know it would have a dual impact on the financial statements. Just think of the double entry or the dual impact of the financial statement, and hopefully you would be good to go. Acha, over here, if I look at assets are equal to capital plus liabilities, equity plus liabilities, is there a change in liabilities? Does he owe someone more or less now? There is no change in liability. What about equity? Is the stake of the owner in the business? Is owner investing more money or withdrawing some money or earning some profit in the business? No, so there is no change in equity as well. That means there would be an increase in asset and there would be a corresponding decrease in an asset. Acha ji, which asset is increasing and which asset is decreasing? So the asset of goods, the inventory that he had, that is decreasing by 600, right? And in order to compensate for that, there is an asset of accounts receivable or debtor. So this person to whom I have sold these goods, he now owes me money, and he's going to pay me this money sometime later in the future. So that's an asset for me right now. Yes? Acha ji. So how would it reflect in the statement of financial position? Acha ji. Statement of financial position. Shop. Any change to it? No. First I'll write assets. Uh, assets. Acha ji, in assets, the first thing I write is shop. You're saying no change. So has the shop always been worth 32,000? Yes, it was 32,000. ठीक है जी. Inventory. Now I have sold something worth 600 out of it. So what remains would be how much? 6,400. Excellent. There will be a new asset of debtors. Debtors are the people who owe us money. Acha ji, how much is this debtor? He is for 600. And any change in the asset of bank? None. So it stands the same way at 28,000. ठीक है जी. Overall, just one asset got converted into another one, so the sum of the assets it would stay the same. There was no net increase in the asset, so it stands at 67,000 like before. And for equity, you're telling me that there is no change. It stands at 60,000, same as before. And liabilities, over here I can write liabilities, or I can write the name of liability the same way I've written the name of assets. I could have written trade payables, or I could have written creditors. So right now I'll just write liabilities. Acha, the sophistication and the, for example, the uh, right now I'm being lenient with the format in which we are drawing things. Little by little, we will learn I mean, gradually we'll be more strict on the requirements of the format and what exact words to use for things. Right now, we are a bit lenient on that. Acha ji, 7,000 for liabilities. So the total it becomes 67,000. ठीक है जी, noted. अच्छा जी, on to the next transaction. How many are there? Oh ho. There are many, at least three more. ठीक है जी, good. Excuse me. अच्छा जी, if you could please read the fifth transaction and let me know what's happening, as in terms of accounting equation. Excellent. ठीक है. So if I write the accounting equation over here, that assets are equal to equity plus liabilities. Any change in liabilities of the business? None. Good. What about equity? No change in liability, no change in equity. Assets, yes, there is a change. One asset has increased and one asset has decreased. Which asset has increased? Excellent. The bank has increased, and which asset has decreased? Excellent. Excellent. Zabardast ji. So you are understanding things. Good. Assets, same way assets. This school, do they offer accounting as a subject? This one also doesn't. The previous one also didn't. What's with these schools and accounting? Who does accounting in Ethiopia? Where do they learn from? If schools don't teach accounting. Acha ji, assets and the asset of shop stays the same way. How much? 32,000. Acha ji, asset of inventory you told me decreases by how much? 400. So it would become 6,000. Excellent. Any change to debtors? नहीं, the debtor doesn't increase, bank does. ठीक है, debtor stay the same and bank it becomes how much? 28,700? No, 28,400. 28,400. What would be the amount of total assets now? Would it change? It wouldn't change. There's just a shift from one asset to the other. ठीक है जी, so the total stays at 67,000. These are your total assets. अच्छा जी, and any change in equity and liabilities? So equity stays at 60,000. Liabilities stay at 7,000 and the sum stays at 67,000. Cool. अच्छा जी, moving on to the next transaction now. ठीक है जी, if you could please read it out and let me know the impact on the accounting equation, please. All right. If I owe a person any money, it's not necessary that, I mean, depending on the my agreement with him, but usually it's not necessary to pay all the amount whenever I'm going to pay him. I could pay that in installments as well. I mean, it obviously depends on the arrangement, but usually the arrangements are in such a way that they are going to be part payments for the amounts owed. Okay, so now coming to this accounting equation impact of it, uh, any impact on assets? Are you sure? Do you have the book open in your system as well? Did you download this one on your system? Would it be helpful if you would open that, or is it better if you just look at my screen? ठीक. I mean, that way maybe you'll have to toggle between the screens, this one and when I'm writing. Do it whichever way is easier for you. If looking at my screen is easier, then we'll just keep doing it this way. But right now, okay, for the sixth transaction, if you could tell me that out of assets, equity, and liabilities, which ones would get impacted, or which one would get impacted? All right, what would be the effect of on liability? Would it increase or decrease? So we are incurring more liability, or we are paying back some liability? So here is this person, B. Blake. Blake is the owner of the business. He pays a check to D. Smith in part payment. The owner is paying. So, for example, if you were owner of the business and you bought the dresses in your boutique on credit from the people who sold it to you, and then you pay those people, would your liability increase or decrease? So, why would it decrease for you and increase for D. Smith? It would also decrease for D. Smith. Okay. The liability. If I'm paying back my creditors, whether it be part payment or full payment, the liability would decrease. If I pay someone whom I owe, my liabilities would decrease. So if my liability is decreasing, what's the other impact on equity or assets or another liability? Because we learned that every transaction it would have a dual impact. Take your time, relax, relax. Read the statement again. Close your book. Just look at my screen. Close the book that you have opened. All right, and what would be the impact on asset? It will also reduce. Simple maths also tells me that obviously if on one side of the equation an amount is decreasing, on the other side the amount it couldn't increase, it also has to decrease. So a liability decreases and the asset decreases. So here are all my previous assets, and there is just one liability. So all right, this liability is going to decrease, and which asset is going to decrease out of all these assets? Excellent, the bank would decrease. Okay, so now let's write this transaction in the form of statement of financial position. I have all the assets, and in the assets, any impact on shop? None. It stays the same, 32,000. Any effect on inventory? None. It stays the same at 6,000. Um, any impact on debtors? None. It stays at 600. Any impact on bank? Yes, so there is an impact on bank. The bank decreases by how much? 3,000. So the amount would become 25,400. And would the amount of total assets change now? Yes. By how much? So it would become excellent 64,000. So now my total assets are 64,000. Okay. Any impact on equity? So it stays the same, 60,000. Any impact on liabilities? What impact? So it becomes 4,000, and the total of equity and liabilities also becomes 64,000. All right. Changes. So this is total equity and liabilities. Liabilities. Okay. Next transaction. Okay, challenge. Challenge. This is the last one. ठीक है जी. The accounting impact. Assets, equity, liabilities. Any impact on liabilities? Good. Any impact on equity? No. So if the only impact is on asset, it would be that an asset increases and another asset decreases. The question is which asset increases and which asset decreases. Excellent. The asset of bank would increase, and which one would decrease? Excellent. Excellent. That would decrease. ठीक है जी. Let's quickly draw the statement of financial position. Assets. Shop. How much for shop? 32,000. How much for inventory? Inventory 6,000. Then for detours, yes, madam. How much for debtors? What would be the new amount? 400. Yeah. And what would be the amount for bank now? 600. Any change in total assets? Good. Total assets and equity and liabilities obviously stay the same. 60,000 and liabilities at 4,000. Okay. Okay. And the total also stays at 64,000. This is my total equity and liabilities. Oh, noted. In this particular table, they've just told you the same thing that we did above. For example, what's the effect of first transaction? The asset increased, the capital liabilities increased. For the second one asset increased, the other decreased. For the third one, again, an asset increased and capital liabilities increased, and so on. So this is something we have already done. This is again another example, I mean, a number of transactions, and each transaction telling what would be G impact. Okay. Homework. Oh, wrong recipient. Two men lease which, and can I delete it from here? Delete for everyone. Okay, जी. अच्छा. This chart you'll read. Homework. There is a difference. I mean, it explains the difference between the current and non-current assets. Similarly, for current and non-current liabilities, I'll explain. That's what I'll start tomorrow's class with. अच्छा जी, and here. Question number 1.1. This you can do. You have to find out the missing figure to balance the accounting equation. Easy. Question number 1.3 you can do. Question number 1.5 you can do. Question number 1.7 you can do. 1.9 you can do. In this you'll just have to write increase, decrease, or show an up arrow or a down arrow. Okay, an up arrow to show increase, down arrow to show decrease. 1.11. This you can do as homework. And Acha, 1.13 also. In fact, you can do all the ones skipping the signs, these A ones, and do as many as you can do. Obviously, the ones that you do will discuss the answers of those, and the